weekend, it felt like one of those moments. The kind where everyone is watching the same headlines, drawing the same conclusions, and waiting for the same outcome. You could feel it online. The tone was already set before markets even opened. War headlines, escalation talk, people saying, just wait for Monday. The assumption was simple. This was supposed to be the moments markets finally cracked. And then Monday arrived and nothing broke. In fact, markets didn't just hold, they climbed. That disconnect between what people expected and how markets actually behaved is the real story here. Because when markets refuse to react the way everyone thinks they should, it usually means something deeper is going on. And that is what I want to unpack today. Not as a chart breakdown, not as a geopolitical rant, but as a way of understanding how markets decide what matters and what they're willing to ignore. If you're new here, I'm Paula. This channel isn't about predictions or hype, it's about understanding how markets behave when the noise gets loud, and why price often tells a very different story from the headlines. And this weekend was a perfect case study. So let's rewind. Over the weekend, headlines around Venezuela dominated the news cycle, tied to actions and rhetoric from Donald Trump. Alongside that, there were renewed discussions, not just speculation, but public talk about other countries. Colombia being mentioned, Greenland being dragged back into the conversation. Whether you see that as strategy, posturing, or escalation isn't the point. What matters is how the market interpreted it. By Saturday night, the narrative had already settled. This is risk off. This spills into Monday. This is the dump everyone's been waiting for. And when a narrative becomes that unanimous, markets stop listening to the story and start watching the positioning. So Monday opens. And here's the key observation. You don't need to understand the charts to understand this. There was no panic. No rush into safety. No volatility shock. No scramble for dollars. No sign that anyone was being forced to sell. Instead, markets absorbed the headlines and drifted higher. Crypto held firm, equities pushed up, volatility stayed muted. And that's not what fear looks like. When real fear hits markets, it doesn't wait politely. It moves fast, it shows up immediately. This didn't. And that alone tells us something important. Here's where most commentary goes wrong. Markets don't move on events. They move on how events change constraints. By the time Monday arrived, everyone already knew the headlines. Nothing new arrived with the open. And more importantly, the trade was already on. A lot of people went into the weekend leaning bearish. Hedges were in place, shorts were loaded. So when markets opened and nothing escalated further, when oil didn't spike, when policy didn't shift, when supply didn't break, the risk flipped. It wasn't that people would panic. It was that they were leaning the wrong way. And that's how you get the most uncomfortable kind of market move. Not a crash, not a dramatic squeeze, just a slow, grinding move higher. The kind that quietly presses shorts without making headlines. That's exactly what we saw. There's an old idea in markets. Bad news that doesn't push price down isn't bearish. That doesn't mean it's bullish either. It means the market is waiting. And this is where people often misread calm as confidence. Markets weren't saying everything is fine. They were saying, show me what actually changes. This part matters because it explains why geopolitics sometimes dominates markets and sometimes barely registers. Markets operate in regimes. There are periods when inflation dominates, rates dominate, liquidity dominates, or fear and crisis overwhelm everything. Right now, we're still in a liquidity and rate expectation regime. That means the markets are focused on funding conditions, central bank paths, inflation expectation. Geopolitics only overrides that when it forces one of those to change. This weekend didn't. There was no immediate energy shock, no forced policy response, no sudden tightening of financial conditions. So the dominant regime stayed intact. And when regimes don't change, markets tend to revert back to what they were already doing. So what would have changed the reaction? This is where clarity matters. It's not that the situation didn't matter. It's that it didn't yet cross a threshold. Things that would have changed behaviour quickly could have been a sustained oil supply disruption, a sanctions spiral that hit trade flows, a policy response that tightened liquidity, visible stress in credit or funding markets. But none of that appeared. So markets stayed calm, not complacent, just conditional. Venezuela in market terms is primarily an energy and inflation story. Greenland is different. That conversation touches NATO credibility, alliance stability, and long-term geopolitical alignment. Markets don't price that instantly, but they do remember it. If talk ever turns into policy, investors start demanding more compensation to hold risk. Prices adjust not because of panic, but because the cost of uncertainty rises. That's how bigger shifts begin quietly. Now let's talk about crypto. Crypto didn't trade the headlines. It traded liquidity conditions. And that's not new, but it's often misunderstood. Crypto reacts hardest when dollar liquidity tightens, when funding stress rises, when volatility spikes. None of that happened. So crypto behaved exactly how you'd expect in this environment. It held firm, stayed sensitive to liquidity, and ignored noise. Longer term, yes, geopolitical fragmentation and financial restructuring matter. But in the short term, crypto still lives inside the same plumbing as traditional risk assets. That's why this calm mattered. There is another thing that people underestimate, and that is time. Markets rarely price geopolitical risk instantly. They wait to see who blinks. Headlines come first, positioning follows, policy lags, economic consequences lag even more. So when markets don't react immediately, it doesn't mean they're blind. It means they're withholding judgment. So, what's the takeaway? Not be bullish, not be scared. The takeaway is this: watch reactions, not headlines. When something truly matters, markets don't need convincing. They move. When they don't, when price refuses to cooperate, that's information. It tells you what markets are choosing to ignore and what they're waiting to see proven. A lot of people are really asking one thing underneath all of this: should I be worried? The honest answer is nuanced. Markets aren't scared yet, but they are alert. Calm doesn't mean safety forever. It means conditions haven't been forced to change, and that difference is everything. Before I wrap this up, I want to say one more thing, because this kind of market can feel surprisingly isolating. When headlines are loud, prices calm, and nobody seems to agree on what matters, a lot of retail traders end up feeling like they're on their own, second-guessing every decision. That's exactly why we built the Crypto Wolfpack. It's not about hype or calling tops or bottoms. It's a place for normal people to think through markets together, to discuss macro, liquidity, geopolitics, charts at high level, and how all of this actually connects. And if you want to know the exact strategies we use to make money in both the bull market and the bear market, we've made a completely free course for you. It's called the Crypto Liftoff course, and the link, along with the link to the Crypto Wolfpack, is in the description below. If this video helped you see markets more clearly, without fear or noise, make sure you're subscribed. Thank you so much for watching, and I'll see you in the next one.